And now I'm going to hand over to Oliver Booth from Sightline Climate, who's basically going to see if the data backs up everything we've just talked about. So no pressure.
Don't worry, if it doesn't, I'll just say it did. Very nice to meet everybody. So I'm going to be chatting a bit about kind of where the data and analytics sits relative to some of the conversations we've been having. The good news is that it's still relatively early days for the SAF market, and so a lot of these trends are still being figured out. So I'm not going to try and kind of contradict people too heavily. So a quick introduction just to explain what I'm doing. I'll keep this relatively short, much to the disappointment of our sales team. What do we do? We're a research and analytics platform. We cover all of climate tech, focus primarily on that question of commercial deployment. We focus on companies and projects that are starting to see real commercial maturity, and those things that are really starting to come down the cost curve and make some difference at significant scale. And we do it for everything across climate tech. Cool. Sales pitch done. So overall, climate tech funding has been an interesting story in the venture capital space over the last few years. There was a really significant spike around kind of early 2021 that we saw, motivated partly due to the sort of frothing exit markets around SPACs and everything else, but also largely thanks to a real appetite from investors who were looking to take advantage of new incentives and opportunities present from the US government and the European governments and governments all over the world that are looking at decarbonization options. However, we've seen a real downtick in the last couple of years around what that funding has looked like. However, what I'll call out is that the deal count is relatively flat. It's been interestingly flat. It's the quantity of investment that's been going down. So really what we're seeing here are a large number of relatively smaller deals trickling into climate tech across a huge range of sectors. Still a lot of money in total that's been going into climate tech, around $200 billion since 2020, split between transport, which has been the biggest sector, was including aviation, as well as energy and food and land use and things like that, picking up the rest of the area. Energy has come up as the kind of primary focus area for climate tech over the last few years. And indeed, in the last year, energy made up a higher proportion of overall investment relative to transportation. But we're starting to now see, with this amount of capital entering the space, these projects and companies are now needing to start to see full-scale deployments. And we've heard a little bit today about that kind of valley of death problem that we've seen, where you have venture capital-backed companies who are seeing real funding going in, but are going to need significantly larger check sizes to start to build these first-of-a-kind plants. I mean, the difference between asking an investor for $10 million and $300 million is a pretty significant conversation. And the bad news, to some extent, for the aviation space is that transport investment was hit the hardest by the kind of downturn as companies have started to hit that valley of death, as some of the government incentives have started to slow down, at least in the US. And we've seen a 36% drop-off in investment year on year between 2023 and 2024, and that trend looks pretty similar through this year. However, there's some kind of bright spot here. Most of that is road transport. EVs, EV batteries, EV charging, that sort of ecosystem, and batteries in particular, were very much venture backable through the first part of the kind of climate tech cycle. And you kind of have two possible explanations here. Option one is it just turned out that wasn't a very good idea. And we saw Nikola Motors and other EV-related companies not doing so well in the immediate aftermath of their kind of commercialization activities. But there's also a more optimistic view, which is these are just too commercial now. We're past that point for venture capital, and we're starting to see a lot more action in different spaces. And that is the good news. So why have I been talking about road transport the whole time? It's because aviation's actually done pretty well. Aviation, for the first time in the trailing 12 months, overtook road transport and batteries as the main way in which, as the main funding for transport venture capital investment across climate-related investments. That is split between the SAF space and the kind of eVTOL hydrogen plane space. Now, I'm not going to spend too much time talking about eVTOLs. I imagine there's a pretty hefty amount of skepticism in this room as a SAF room about the kind of role that they play. What I will say is that the SAF investments have primarily focused around PTL and e-fuels. There's been a few VC investments, of course, for particularly for alcohol-to-jet and Fischer-Tropsch bio-SAF routes, but the majority of VC funding for SAFs has really been on that e-fuels PTL story. That has been through big deals with people like OxyCU and MetaFuels, and there's a bunch of names, many of whom are here today, who benefited from that. But this is a pretty small amount of money relative to the kind of total investment that's needed for sustainable aviation fuels to take off. We're looking at sort of somewhere on the order of $500 million that's gone into SAF investment in the last 12 months on the kind of venture capital side. And there's a little bit more before that, frankly not that much more before that. So we're spending the rest of the time talking about deployment. That's kind of a more interesting piece here around what kind of projects are actually getting built. I'm going to do some quick definitions here. I'm talking about HEFA, high sugar biomasses going into alcohol-to-jet. There's some Fischer-Tropsch bio-SAF, but thanks to kind of high-profile failures, it's been a bit slower recently. And then the handful of e-fuels routes. But I realize that speaking at the end of the conference means that you guys are well familiar with this term, these terms by now. So we track all of the sustainable aviation fuel projects in the space. We see of ones that have announced capacities, around 230 projects that are kind of in development, representing 62 billion liters a year of announced capacity. There are, of that, only about 9 billion liters are actually operational. So we're seeing a lot of projects in these early stages of announcement, a lot of them pre-FID, particularly for those projects that are looking at feeding into the blending requirements in the EU, but also most of the ones in the US as well. And a few kind of larger operational plants, but most are around that 100 to 200 million liter per year mark, which we view as the kind of small commercial scale. We also see plenty of demonstration and pilot plants, but those aren't really making a dent in terms of the overall capacity that might be coming online. The story here really is just that we're in the early days of deployment for SAF, which maybe is a little bit obvious. Most of these projects are in development, there's a little bit operational, and what we're seeing also is that there are very long lead times between when a project announces it's going to be in development and when it actually starts construction, with a relatively short construction periods tending to be sort of 2 or 3 years. These are partly because these projects generally are a little bit smaller than kind of normal commercial refinery projects, but also because these long lead times are part of this long process of acquiring different investors. So one of the features of climate tech in general and first-of-a-kind commercialization projects is this need to get multiple sources of capital in order to see these projects hit maturity. So oftentimes, particularly for non-HEFA projects, the actual commercialization, actual financing process for this involves stacking a lot of different types of capital on top of each other in an effort to figure out, basically because nobody's willing to take on enough risk to justify paying for the full freight for one of these projects. The other component is the offtake problem. There's a long conversation with airlines that feed into how offtake how much offtake is needed, what proportion of your offtake do you need to be signed for, as well as the fact that airlines are simply unfamiliar with how this process works in a lot of cases. These are very differently structured contracts than airlines are typically used to, as we kind of heard a little bit about over the last couple of days. Most of these projects that have been announced are scheduled to come online in 2027 and 2028, whereas most of the kind of e-fuel and PTL projects, which I haven't highlighted out directly, are generally coming online a bit later, which is in 2029, 2030, and with the exception of a handful of projects in the US, generally in Europe. So digging a little bit more into the technology profile, perhaps unsurprisingly, most of the SAF that's coming online is HEFA. And to some extent, I'm going to kind of ignore bits and pieces of that as we go forward. But the projects that are currently operational, most of that capacity is coming from co-processing facilities. Now, it's worth noting that this is the capacity, not the actual production amounts that we're seeing from these plants. So if all of the facilities that have co-processing capabilities were to operate at max capacity, usually 5% of their overall capacity, they'd be producing a lot more than they currently do, put it that way. Whereas most of the stuff that's coming online over the next few years is really this part of this HEFA story. But I want to spend some time talking a little bit more about all the others, because I think those stories are a little more interesting. Bioalcohol-to-jet is the main second place, and that's thanks in large part to the US corn ethanol industry. A lot of these projects, most of the alcohol-to-jet projects are in the US, and most of those are taking advantage of either US corn ethanol or occasionally Brazilian sugarcane ethanol, although the changes that have been proposed in the US current budget bill might mean that that Brazilian sugarcane ethanol is no longer a viable feedstock for the 45Z tax credit. We'll see whether or not that goes through, or what that looks like when it goes through, but that'll be an interesting story for this. There were a lot of Fischer-Tropsch bio-SAF projects in development. Now, a few of these have been canceled, and these numbers, upon update, look a little bit lower. And we're seeing a lot more projects come up in the kind of PTL e-fuel space, particularly over longer time horizons, as we start to see these. I think the thing to watch within the US is going to be whether or not this bioalcohol-to-jet industry is able to operate the way that it thinks it's going to be able to in terms of taking advantage of that ethanol industry and feeding into those feedstocks. Corn ethanol producers, I don't know if we have any here today, are worried about the rise of EVs in the US and worried about the impact that'll have on gasoline markets. And so when they're thinking about their long-term offtake, they're trying to figure out how do we continue to sell the quantities of ethanol that we're selling today in 2030, 2035, if we're going to see significant market penetration from EVs and a plateau or decline of gasoline markets. And ethanol to jet has been a promising alternative for them. And we're starting to see more and more collaborations and partnerships between the big industrial players in the US when it comes to corn ethanol and some of these alcohol-to-jet projects, whether those are tech providers or the producers themselves and project developers. On the kind of e-fuels and PTL side, it's looking a lot more like you're going to test your plant in America and then you're going to build it in Europe. That seems to be the kind of general attitude. And that's been largely reflected in where these projects are being built. So most of the announced projects are in the US. That's thanks to very strong infrastructure, availability of feedstock for HEFA, availability of those refineries. There's a lot of reasons to take advantage of the US market. But keep in mind, of course, that all of these projects, with a handful of exceptions, were announced prior to the current administration. And the changes in policies and priorities of the current administration are likely to mean some significant changes in how many of these projects actually end up getting built. One feature of the United States fuels industry is that whereas in Europe and the UK and elsewhere, alternative fuels are viewed as part of the energy, maybe transportation, maybe sustainability sort of criteria of the government. In the US, biofuels are part of the agricultural policy. And that means that the voter base and the lobbying base of those groups is significantly different. Really what I'm trying to say here is that Republicans really like biofuels in a way that you wouldn't expect them to. It's a odd quirk of the system, but it does mean that things like the 45Z tax credit have remained in place, at least per the concurrent draft of the bill, of the big beautiful bill, I think it's called, which makes me uncomfortable every time I say it. And so we're likely to continue to see some of those incentives in place, but for PTL and hydrogen-based projects, those are really going to suffer from the lack of incentives that we were expecting to see that have been passed through the Inflation Reduction Act. Outside of the US, Europe is really taking up kind of second place, which is maybe unsurprising. What was surprising, at least for me, was the proportion of those projects that are being developed in the Netherlands, with a pretty good spread throughout the rest of Europe as well. Now, Europe represents something like a fifth to a quarter of the total plants, of the total capacity that's been announced in terms of global SAF capacity. But it also represents more than 2/3 of the planned e-SAF capacity. So PTL is looking a lot more secure here than it was in the US. There's a pretty obvious explanation for that. You're going to have to buy it, so of course there's a market for it, which at least that's the kind of logic as these build out. Whether or not Refuel EU, I think there's some concerns that it may not continue to exist in the form that it currently exists in the long term, but certainly most people seem pretty optimistic about that. And so PTL projects, particularly larger PTL projects that are going to need significant commercial offtake, those are generally getting built, or at least getting planned for Europe. However, the handful of projects that have had commercial partners pull away, particularly large oil and gas majors, in the last few years may result in more project cancellations. Right now, we've just had people pull out, but those projects are still planning on going ahead, so they're still reflected in these numbers. But there might be a few more of these that decline over the next 6 months to a year. But generally speaking, PTL is looking surprisingly, well, not surprisingly, more secure in Europe than it is in the US. That was the kind of majority of the data I wanted to get through, because I wanted to leave some time for questions as we go through everything else. I realized I should have prompted that earlier. I didn't think that through. I was thinking everyone's put hands up, but we have this the app now. But yeah, I'm gonna leave it there. Sorry.
You've got one on Slido, which is, do you see production capacities being announced in the African continent?
Yeah, good question. There have been a handful of projects announced in Africa, particularly in kind of North and West Africa. But in terms of overall production capacities, there have been significantly fewer. There is some hope and some attempt to do PTL in North Africa and then sell that on to Europe through the kind of to take advantage of that. The issue is that due to lack of incentives for the actual use of e-fuels and SAF in general within the kind of African continent, there are fewer opportunities for people who are looking at purchasing large amounts of SAF within Europe. So, it's a bit of a more complicated story, I think, as people are hoping to kind of export from Africa rather than necessarily produce and consume within the continent.
Any other questions from the floor? Yeah, Glenn's got one.
What do you see the effect of carbon coming into the mix of this? Because a number of projects have got byproducts such as biochar or others. You've got the Corsair mandates as well, albeit that need strengthening and everything. Where do you see carbon fitting into this in terms of either removal or CDR or feeding back into an e-fuel?
Yeah, I think what we've seen is that the market for and the appetite for voluntary market and voluntary carbon purchasing has sort of dried up in the last couple of years. As a result, it's really been centered around those compliance markets. As a result, most of that has been viewed as kind of an adder to the European incentives and the European market as people are looking at feeding into the ETS or looking at kind of getting around CBAM and things like that. So generally, it sort of is adding a second layer of incentive on top of the kind of European market. Now, some of that carbon pricing and carbon marketplaces in Asia has also produced some interest, particularly in Japan and Korea, as projects have started to go forward there as well. And part of that is direct government incentives, like governments just providing grants. But part of that is also an interest in trying to maintain within the kind of carbon limitations of those projects as well. So it's mostly in Europe that we're seeing that come through, but there's a bit in Asia as well.
Do you want to take either of those?
Yeah. The investor profile remaining interesting in climate tech. I think what has happened over the last kind of year or so has been there was previously the kind of investor that liked climate tech was there were a lot of non-climate focused investors who were getting involved in climate tech, particularly in sort of 2020, 2021, as like this is a new economic force that is moving forward. Also a lot of activity from CVCs through that. I think a lot of those CVCs, although not all, have stayed on through the kind of transition, but most of the non-specialized investors have kind of dropped away. Now, some of that's a good thing. I understand that there are concerns around the impact that non-climate investors can have on the priorities of companies that are looking at driving impact forward, but also there's just less of that capital available. What's also happening is the kinds of deals that climate investors are focused on has changed dramatically, particularly because they're all eyeing up, or many of them are eyeing up lower check sizes. And so they're paying more attention to the overall capital requirements of the company, a lot of appetite for software solutions, enabling solutions, marketplaces, things like that. And so we're starting to see more and more people looking at these less hard tech ways of viewing climate tech, whereas historically it had been much more of a hardware sector.
And do you want to quickly comment on production capacity in China?
China is hard to track because they tend to announce projects when they finish them rather than while they're building them. And so what we tend to see is these projects get announced and completed kind of sequentially. It does exist. It is growing. There's an appetite for export of fuel from China. China doesn't have as many incentives for the kind of use of SAF, but instead they're kind of eyeing up that as an opportunity as another kind of export market. It does have a price advantage, particularly when it comes to HEFA, because their price of UCO is so much lower, and frankly, the environmental creds on it are a little bit more questionable. It's harder for them to export as a result, though, because of those environmental credentials, so there may be issues when it comes to trying to sell into Europe. So it's cheaper, but you get what you pay for. So number of SAF production pathways, outright winners. The trend seems to be one of geographic concentration. So in certain geographies, there is a lot more appetite for certain pathways than others. I think US is seeing a lot more ethanol to jet. Europe's seeing a lot more PTL. And those sorts of production pathways are going to continue most likely to converge around the policy, the shape and color of the policies that are out there. That's all the time I have.
Perfect. Thanks, Oliver.
Thank you.